I want to move on here because I want to get some ideas from John here. We have roughly 5 months left in 2019 with the markets at all-time highs and the S&P sporting a nearly 20% return this year. Investors are looking for ways to position themselves. Going into year-end, John, you brought along 3 ETFs you think bear watching. I know you're very big on gold, and gold's just started taking off in the last 6 weeks. After being a loser for years, gold stocks as well. Why do you like gold and gold stocks?
Well, I think your opportunity cost for owning gold is low, so you've got rates that have been going lower. Meanwhile, recession risks have increased. The bottom line, S&P is up 400% the last 10 years. Gold is up 50%. The miners are down 10%. So, recently one of the greatest hedge fund investors ever says he likes it. I think that's a huge catalyst for gold. So I think a 5-10%.
You're talking about Ray Dalio at Bridgewater.
Correct, Ray Dalio. So I think a 5-10% allocation to gold, it helps diversification. It gets higher risk-adjusted returns.
And I know you like quality as well. You're big on earnings growth. You're big on dividend growth. There's a firm out there, there's an ETF out there, DGRW, that really does both.
Correct.
And yet, it sounds like a great idea. I like quality too. Does it actually outperform?
Well, I think if you look at risk-adjusted returns, it has outperformed the S&P 500 since inception. So we like that. I think we like it because if you buy just pure qual, like the QUAL ETF, that's trading at 19, 20 times earning. The S&P is at 17 times.
The difference here is this has earnings growth and dividend growth on top of it. And the difference between that and QUAL is what?
So qual is just pure quality, whereas DGRW takes 50% quality screen and 50% earnings growth screen. So I think it's a nice blend.
Okay.
Bottom line, DGRW trades at 16 times earnings, S&P 17, 18. Qual at 19, 20.
I want to move on. Emerging markets. I'm surprised that you like emerging markets, given how cautious you are on the overall global economy. Emerging market dividend payers. There is an ETF for that. This always amazes me. EDIV. Why do you like emerging markets and why dividend?
See, I think the opposite of what you just said. I think U.S. is riskier than emerging markets because you're trading at 10-year highs in terms of valuation. So EDIV is just a quantitatively driven screen. Strong earnings, strong dividend growth. It's 100 stocks. If you're trying to outperform the benchmark, you need to do something different than the benchmark. So EDIV has very little overlap with EEM. It trades at 10 times earning. EEM is at 13 times earning. EDIV has outperformed EEM by 150 basis points. So that's pretty good in my book. Higher Sharpe ratio.
Dave, gold, quality, and emerging markets. Reaction?
Yeah, well, so I think the emerging markets play is the most interesting one here. The thing to be cautious of with something like EDIV is you're getting a lot of sector exposure. That fund's loaded up on financials. It's loaded up on energy stocks. You're getting things like Gazprom in it, names that we all know. So some might argue there's a reason some of those stocks are trading at PEs of 8, 9, and 10. But you're right. I think emerging markets is one of the greatest value plays we've got available in global equity.
Yeah.